Welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. Joining me at the market site in Times Square, New York City, we have Tracie McMillion. She's the head of Global Asset Allocation Strategy at Wells Fargo Investment Institute. And the Institute is out with its 2020 Outlook piece, and it's all about resiliency. Tracie, it's great to have you with us at market site. Welcome.
Thank you.
3 factors are necessary for this global economy to stay as resilient as it has been.
Sure, yes. And those 3 factors actually all began with C's. So they're consumers, making sure that the consumer continues to spend. You know, here in the U.S., the consumer is 70% of the U.S. economy. And so as long as they stay resilient and continue to spend, then we should see this expansion continue. The other thing we're watching is China. So certainly within China's own borders, they are going through a big transition where they're moving their economy away from exports and more toward consumers in their economy as well. So they're looking at consumption industries. And as they go through that program slowdown and transition, they will have a big impact on the global rate of growth. And then the third thing is credit spreads. And so credit spreads have been very well contained so far in this expansion, but should they start to widen out, that would be a signal to us that something bigger could be a problem.
Why is that so impactful to the markets, to investors, if they do widen out?
Yeah, that's because that means that investors are not willing to take on as much risk with credit. So if they demand higher interest rates, which is essentially what's happening when your credit spreads widen out, there's a difference between the high quality and the lower quality, and those interest rates go up on lower quality, then that means that lenders are less willing to lend to those businesses, and they could start to feel a financial squeeze.
All right, and you also mentioned 5 ways investors can pivot away from higher risk asset classes.
Yeah, so there are 5 things that we're suggesting that investors do going into 2020. The first is that they use cash in their portfolios. You know, you don't always hold a large position in cash in your portfolio, because in a year like 2019, it was a performance drag on your portfolio. And moving into 2020, though, we're suggesting holding some cash and using it as a tactical tool. So in other words, if the markets rise above our targets, then you would sell some of those markets and take the cash out of them. And then you would reinvest if they go below our target. So, you know, kind of using that throughout the year as markets fluctuate, because we think there'll be more swings next year than there were this year. And the second thing is to focus on quality, and focus on quality both in equities and in fixed income. In equities, that means moving up in market capitalization, not as much in small caps, but maybe moving some of that exposure into U.S. large caps. And within fixed income, moving away from things like high yield fixed income, where we just don't think that the return or the yield is worth the amount of risk, and moving up in quality.
I mean, and it makes sense too. There's a reason why certain assets have a high yield.
Yes, exactly.
Because the underlying is not performing.
Yes, again, you know, those lower quality. And right now the spreads are pretty tight, but they could widen out quickly.
All right, and the fourth one, defense can be good offense.
Mm-hmm. Yeah, so what we mean here is that within the portfolio, there are different asset classes from which you can choose. And certain asset classes are more defensive than others. Hedge funds come to mind, or other alternatives, as a good hedge within the portfolio, because equity hedge strategies in particular can do well whether markets are going up or going down. So, you know, they can buy long or they can sell short and benefit either way. So that's certainly a defensive play that we're suggesting. Another way that you can be more defensive in the portfolio is to invest more in those sectors where you're getting more yield. So things like REITs or utilities, you're getting that nice dividend income stream from those, and they may prove to be more defensive as well.
All right, and the fifth one, of course, tried and true diversification. Can't go wrong there with longer term investments.
Sure, so longer term investing is something that we stress with with our clients, and the main reason is because even if you're diversified, if you look at a diversified portfolio over just a 1-year period, you see a lot of variation in the returns from year to year. So we looked back and saw that there was 51% spread on the 1-year returns for a balanced portfolio. So anywhere from negative 21 all the way up to 29%. And if you stretch those out over 10 years and you average out the returns over 10 years, that number shrinks considerably to about 8%, anywhere from 5.3 up to 14%. So having that longer term viewpoint can smooth those returns over time and keep you invested in the markets.
And speaking of diversification, the report also spotlights on alternatives.
Yes, exactly. So we do favor the equity hedge, as I mentioned, and other private capital. For example, we also are investing in private equity and private debt. Private debt in particular, we're looking at distressed and stressed debt. So we think right now is a good time to be investing with those managers who can move in if we do see credit spreads starting to widen out and we do start to see stress in the credit markets. We do think we're late cycle, and when you're late cycle, that's when you tend to see those spreads widen out. You start to see distress or stress in those markets, and it's a good time for investors to go in and pick up something, 85 cents on the dollar, and wait for those to come back.
All right, and to wrap up here, you'd mentioned in the beginning of the interview that we might see a little bit more up and down movement in 2020 as compared to 2019, and I would imagine some of that's got to be around the 2020 election.
Sure, yeah. So in fact, we looked back at all of the election cycles, and what we found was that there were only 4 years in which there were negative returns when it was an election year. And 3 of those were recession years. We're not calling for a recession next year, so we do think markets will be up. But in the first 6 months or so, markets tend to be flat to down because of the uncertainty with regard to who the candidate is going to be. And then once that candidate is chosen, then markets will either go up or down depending on whether they think the incumbent is going to win, in which case it tends to go up. And if not, if the challenger is going to win, then it tends to go down. Again, uncertainty coming into play there.
All right, Tracie, thanks so much for joining us at
Thank you.
MarketSite. And thank you for joining me on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.